Hi guys, I'm happy to be with you this today. Again, my name is Joseph Ejike, and I will keep you company again today. Our topic of discussion in this finance class today is a continuation of where we stopped from the last lecture. Now, um, I will start by sharing my screen, and then we'll go from there. So now, I started by explaining how to check the vital signs of a company using the financial statements. So last time we did how to calculate cash flows and other performance evaluations. Today, we'll start with the beginning of financial statement analysis using a different method that we call ratio analysis. But before that, I want to give you some background information on this about the analysis of financial statements. So, let's just begin. Now, financial statement analysis simply means comparing the firm's or a company's performance to the industry, and also evaluating some of the trend in the company. And when I say trend, I mean with respect to their financial position over time. Now, managers use financial statement analysis to identify situations in the company that needed to be fixed. And then lenders also look at the result of financial statement analysis to see if a company is credit worthy. If they can, if the company is asking for a loan, for instance, they analyze the company's financial statement to figure out if they can approve the loan, provided that the financial statement are indicating that the company is credit worthy. Now, of course, stockholders, those that already own shares in the company, they like to, in fact, they analyze their company's financial statement to make predictions about things like future earnings, dividend, free cash flow, and so on and so forth. Now, potential investors like me and you, analyze the company's financial statement to see if it is a good company to put our money into, to buy their shares. So if the financial statement analysis result tells us that this is a good company, then if you have the money, then you buy the stock and hold, buy and hold. I'm always an advocate of buying and holding, value investing. Let me put it that way. Now, so these are the things that we get from financial statement analysis. Now, the first steps in financial statement analysis is to gather the information that you need about a company. I recommend you read everything that you can lay your hands about a company. Then, of course, the core thing that you also have to do is to analyze the company's financial statement. Now, how do we gather data about the information? There are many websites, tons of websites that deals with company analysis and so on and so forth. I have three that I recommend. One is Yahoo Finance. The website is finance.yahoo.com. Let me show you, take you to Yahoo Finance so you can see how to use it. I have to open the website. Okay, let me see what I can do here. I'm going to open the website, open the internet, and then, okay. From there, we go to Yahoo Finance, which is right here. Type finance .yahoo.com. So it will open up the section of Yahoo that deal with finance. Now you can then look for the company. Usually you search for the name of the company using their trading symbol. For example, tonight, our analysis tonight will be based on Walmart financial statement. You all know about Walmart is a multinational grocery stores, have branches all over the world. So their trading symbol is WMT. I type WMT here, you can see it gives me Walmart Incorporated. Like if I click on it, and then it can open Walmart, and you can see all kind of information, summary, company outlook, the chart about Walmart that tells you if it is doing well or not, and also the conversations, the other statistics that you have about Walmart. If you want to know about how the stocks have been doing over time, you click on the historical data. It will bring you the stock price for Walmart. So you can see different stock price at different days, and so on and so forth. And then, of course, the financial statement you can get from the financials. Once you click on it, it shows you the income statement, and you can also see the balance sheet if you want to that, and also the cash flow. Okay. Now, this is just one of the websites you can go and get information. Another website you can go, which is the ZAC Investment Research website. And the website is zax.com. Let me show you. Take you there, zax.com. You go to zax.com, click out. Then you can search for any company that you want, as long as the company is publicly traded. You go here, like I said, we are using Walmart. I can type WMT, put the trading symbol. You can see Walmart is out. You click on it, and then it will bring up Walmart data. See Walmart Incorporated, and then from there you can look at search for what you are looking for. Like if you are looking for the analysis financial report, you have the analyst report. Then if you want the financial statement, you can it has it here. Let me see if you have it. You should have it right here. But everything about this format you can see here. Once you click on it, you can see the stock chart for Walmart. Let me see where they have their financial statement. Let me see. Look at right here. See where you have the financials. You see the financial overview, income statement, balance sheet, cash flow statement. Now, the other website you can also go, that one is the SEC, the Security and Exchange Commission. It's like a form of regulation, an agency that every company that is publicly traded in US stock exchanges are required to file their financial reports with the SEC, that is the Security and Exchange Commission. So when you go there, you can see all their filings, including their financial statement. So sec.gov, let me show you the website so you can just go there. So these are free websites. You can get information about any company that is publicly traded. So sec.gov. When you click on it, you see the now you can search for the commas, see say company filings, click on it, and then type the company symbol, trading symbol, WMT for Walmart, and that it will bring up Walmart. You can see right here, Incorporated, and you click on it, and then it opens up. Now, usually the financial statement that comes under 10K annual reports. Click on it, and then the annual report ending in January 31, 2021. So those reports will now open up. Once they open, you can download them and do it with them, use them for whatever you want. Like now, this is the, once you scroll down, you can see where they have their financial statements right here. Click on it, and you see some of them. The first one you see is the consolidated income statement for Walmart. And then next one is the balance sheet, and so on and so forth. So this is basically where you see those information. So you gather the information you need, and then once you gather the information, you can now begin your analysis. Today, our analysis for today will be, like I say, we'll be using Walmart, a real company, and the analysis will be ratio analysis. Now, what is ratio analysis? Well, a short way of saying it is that that ratio tell us the vital signs of a company. So just the same way that you go to a doctor and the doctor will check your vital signs, blood pressure, sugar level, cholesterol level to see if you are alive. That's the same way that ratio analysis tell us the vital signs of a company. Okay. So ratio analysis is a quantitative way for obtaining information about the company's functional efficiency, liquidity, revenue, and profitability. And by analyzing the company's financial records and statements. So that's basically what ratio analysis is about. A quantitative way of obtaining information about a firm's functional efficiency, liquidity, revenue, profitability by analyzing its financial record. Now, in plain terms, it means that you get information about whether it is a good company to invest in or not by analyzing their financial statement or by doing ratio analysis. Now, we have 5 basic financial ratios that we use to check the vital signs of a company. We have the liquidity ratios, the asset management ratios, debt management ratios, profitability ratios, and the market value ratios. Today, we'll be working only on the liquidity ratios for Walmart. And then in other days, in subsequent classes, we'll be talking about as other ratios. And when we finish that, the class continue, we'll go into something else about, companies, corporate finance. Yeah. Now, anyway, let's continue. Liquidity ratios. Okay. Now, we call them liquidity ratios because they tell us the ability of a company to pay their bills. In other words, that they are metrics that we use to determine if a company can pay their debts, can pay their bills. I mean, when I say bills this time, I mean it's short-term bills, current bills like wages, account payable, among the owe their suppliers, and the amount they owe to their lenders in the short that are due in the short term. So I'm talking about bills that are due within a year or less. That means monthly bills, their utility bills, So use liquidity ratio to check those things. Now, they are very important to investors and creditors because they use them to determine if a company can cover their short-term debt obligations. So, generally speaking, the higher the liquidity ratio, then the better. That means the company have enough current assets to settle their current debts. There are two liquidity ratio we're going to look at. The first one is the current ratio. You can see it right here, current ratio. The second one is the quick ratio, or what we call acid test ratio. Okay. So look at current ratio. So current ratio measures a company's ability to pay off its short-term liabilities with its current assets. Of course, you know that current liabilities are those debts that are due within a month, from 1 month to 1 year or less. Now, use current ratio to calculate it. And usually, if your answer is 1, less than 1, that means the company doesn't have enough, it's having problems. It doesn't have enough current liability, current assets to pay their bills. If it is 1, that means the company can, can barely survive. It can, whatever it makes, it can settle the bills. Then after that, you have nothing left. But it's bigger than 1. That's the one we are after. That'll tell that, yes, they still have surplus after paying their bills. Okay. Now the formula of current asset is, so current ratio is current asset divided by current liabilities. Now let us check the current ratio for Walmart for the year 2020. Okay. In the process of doing that, I will also calculate their current ratio for 2021, even though for the first 2021 have not ended yet, but at least the first quarter have ended. So let's see. I will take you to the financial statement of the balance sheet of Walmart from here, so that we can do the calculation. So we have the balance sheet of Walmart right here. We have okay, this is the income statement. Let's look at the balance sheet of Walmart. So let's see. Okay, let me see. Open it up. Okay, right. Let's see if I can click on this. This gives me the, okay. I want to open it up. Let's see what happens here. I have the income statement, but the balance sheet I'm looking for. Okay, balance sheet. Okay. 1 minute. I'm gonna move this up a little bit. Okay. Let's see. Got it. Now, this is the balance sheet of Walmart right here. Okay. Now it says this is 2021, 2020. Let me make sure you're seeing this. Yep. 2021, 2020. So I'm gonna make it bigger so you can see it better. Okay. Good. Now, see 2021, 2021. We are looking for the current ratio for Walmart in the year 2020. So I'm gonna take you here. Now, for current ratio, we have current assets. Say current assets divided by current liability. Current ratio Walmart. Okay. Okay. Now, so as a reminder for the formula is right here. The current assets divided by current liabilities. Okay. So we have it here. For Walmart, the total current assets are here. Let me make sure, because all these are currencies and in dollars. So let me just put everything in dollars. Okay. Then here, for the liability section, everything is in dollars as well. I put them in dollars. Okay. Hope you can see this. All right. Now, current assets. So these are the current asset here. Cash, receivable, inventory. So you see the total current assets. Then for liabilities, current liabilities are here. Accounts, short-term borrowings, account payable, accrued liabilities. But you have this. We are going to be using the total current liabilities. So I'm using the total current assets, so that the current ratio for Walmart becomes equals, like I explained before. If you want to use do any calculation in Excel, put equal sign first to put it in a read mode. Total current asset in 2021 divided by total current liabilities, which is this one here. You can also see the calculation right here at the top here. Then press the enter key. That gives us the current assets, and then you copy it to next cell so that it will calculate for 2020. That gives us this. Now, how do you interpret it? You mean that let me make them just 2 decimal places. 2 decimal places. I'm going to format this cell and make it 2 decimal places. Okay, just number. Okay, these are decimal places right here, and then so now you mean that for each $1 Walmart owes, for each $1 of debt. Remember, this one is for 2021, and this one is for 2020. For each $1 of debt that they have only 97 cents to pay it. That is for 2021. And for in 2020, for each $1 of debt they have only 79 cents. You know, this is understandable because last year was just when the COVID-19 pandemic struck. Many grocery stores, many companies were struggling. Now, which means that if Walmart is owing, let's say, $1 million in 2021, then it has only $970,000 to pay it. So it doesn't have enough to cover the debt yet. But in 2020, that was even worse. For every $1 million debt, it has only $790,000 to cover it. So, but from now that we are coming out of the COVID-19 recession, so you can see that if you look at the trend, you see that actually the current ratio improved from 2020 to 2021, because in 2021 it's only 0.79, but now it's 0.97. That means they are getting better now. So that's basically how to calculate current ratio, and that's how to interpret it. But one thing about current ratio is that it usually factor in inventory. So there's unsold inventory. Sometimes it might not give us the exact position of the liquidity position of the company. So that's why I prefer to use the other liquidity ratio, the one we call the quick ratio. Okay, quick ratio. So that will be the next one we're looking at now. Quick ratio. So let's look at the quick ratio. Before I do that, I want to explain more thing. Creditors like high current ratio because it means that the company can pay their bills. But shareholders doesn't like it because it means that there are so many unsold inventories or so many assets lying idle that the company should have, taken care of to be able to, do more projects. Now let's look at the quick ratio. Quick ratio, or what we call acid test ratio, simply means it measures the ability of the company to pay its current liabilities when they come due with only quick assets. Now, so the ability of the company to pay their current liabilities, that is their current debt, when they are due, using their quick assets. When we say quick assets, what do we mean by that? Quick assets means those assets that can be converted into cash within 90 days or less. So for Walmart, I'm going to show you what the quick assets are. For Walmart, look at the quick assets. Things like the cash and cash equivalent, receivables, the account receivables. That means they have already sold something. When they sell something to their customer and the customer haven't paid yet, but they will pay for account receivable. Then, so this cash and cash equivalent receivables and I would say prepared expenses and others. We don't involve inventory in them. The quick assets, So cash and cash equivalents and account receivables. Now, every company have have others that have some things that are also constitute their part of their current assets. For example, some companies say cash equivalent, short-term investment, or marketable securities, account receivable. These are quick assets. So to calculate quick ratio, we do current asset minus inventory divided by current liabilities. So for Walmart, you can do it that right there. For Walmart, let's see, quick ratio. Okay, so you have equals the current assets, okay, which is total current assets, minus the inventory right here, with parentheses, divided by current liabilities, which is total current liabilities. Now you can see the calculations here too. F39 means column F, and then 39 will be total current asset. So when you press the enter key, you give it the result, and now you can copy it to calculate for 2020. So this means that in 2020, let me format this. Okay. Okay. So I gotta make it to the smart places. Format the cells. Okay. Right. In 2020, for every $1 of debt Walmart owes, it has only 22 cents to pay it off. That means if he owes, for instance, $1 million in debt, he has only $220,000 to settle the debt. Now, we have removed the inventory, so that's why it went down so far. So if you can now compare this with the current ratio, you see that difference. Then for now, this year, the year haven't ended yet, but there's been even improving now. There's been some improvement because now it has 49 cents to settle each $1 of debt, which means that if he has a, let's say, $1 million debt, he has $490,000 to pay it. So there's an improvement, but it's not quite there. So you can do this for any company. So if a company, let's say that our answer is, let's say for answer for Walmart for quick ratio is 1.2, and then 1.4 here. It means that for each dollar of debt it owes, it has $1.40 to pay it. That means it still have a surplus. It means that if it is owing their creditors $1 million, it has $1,400,000 to pay it. So it still have enough money to pay. The same thing with here. If it's owing $1 million, that means it has $1,200,000 to pay it. So it is liquid. This is basically what liquidity ratio is. In a subsequent lectures, we'll be looking at the other ratios, such as the asset management ratio. I hope you enjoyed the lecture, and I'm glad to be of help, and I'll see you in my next lecture. You have a good day, and bye-bye.